Hey everyone, welcome back to Corporate Decoder. Today, FundVantage Trust just filed their N-CSR report for the 30th of April 2026, and I'm seeing some interesting takeaways about their private capital management value fund. Quick note, this is not financial advice, just my take on public filings for educational purposes. The fund's performance is lagging behind its benchmarks for the year, but showing strength over the long term, and that is a story we often see. We are diving into the annual shareholder report from FundVantage Trust for their private capital management value fund. This is the official rundown of how the fund performed and what it holds as of the 30th of April 2026. This report covers the period from May 1, 2025 to the 30th of April 2026. They are sharing information about the private capital management value fund, specifically Class I shares identified by the ticker VFPIX. You can find more details on their website or by calling them. Let's start with what it costs to invest. For a hypothetical $10,000 investment in this Class I share, the costs for the year were about $129, which translates to 1.20% of the investment. This is the expense ratio, essentially what you pay annually to have your money managed. Now for the performance for the 12-month period ending the 30th of April 2026, the fund returned 14.3%. That sounds pretty good, right? But get this, it actually trailed behind the performance of the Russell 1000 Equal Weight Index and the Russell 2000 Index. The report mentions that this fund doesn't try to perfectly match a benchmark, which is what passive funds do instead. Its managers aim to beat those benchmarks over longer periods, typically 3 years or more, by picking about 35 specific investments they believe have strong growth potential and can weather downturns. They do this by research into the company's fundamentals and management. When we look at the table comparing a $10,000 investment, the fund's Class I shares returned 14.26% for the year. But compare that to the Russell 1000 Equal Weight Index, which returned a whopping 29.29%, and the Russell 2000 Index, which shot up 44.41%. So for the last year, this fund definitely underperformed. However, the report highlights that over the trailing 5 and 10-year periods, the private capital management value fund actually outperforms both of these indexes. They say this is because they focus on long-term tax-efficient results and hold fewer, but often more impactful investments. They often keep more than half of their money in their top 10 holdings, so each of those positions can really move the needle. Looking at the fund size as of the 30th of April 2026, its net assets were just under $68.4 million. They held about 30 different investments in their portfolio. This section is essentially a stamp of approval from their auditors, PricewaterhouseCoopers LLP. They've audited the fund's financial statements for the year ended the 30th of April 2026 in their professional opinion. The financials present a fair picture of the fund's financial position, its operations, and how its net assets changed. They confirmed that the audits were done according to the standards of the Public Company Accounting Oversight Board. They also mentioned they've been the auditor for these companies since 2011, which shows a long-standing relationship. Now let's get into what the fund actually owns. This is where we see the rubber meet the road. As of the 30th of April 2026, about 89.8% of the fund was invested in common stocks. A big chunk, 26.1%, was in financials. This includes companies like ACNB Corp, Bar Harbor Bankshares, BGC Group, First American Financial Corp, Home Trust Bankshares, Jefferies Financial Group, and KKR. It shows they have a strong belief in the financial sector. Next up is healthcare, making up 15.1% of the portfolio. Here we see holdings like Harrow Inc., Lantheus Holdings, and Ligand Pharmaceuticals. This is another significant area of focus for the fund managers. Communication services accounted for 11.8%. Companies like Perion Network Ltd and Quinn Street Inc. are listed here. Industrials represented 11.1%, with holdings including Aircell Corp, Astronics Corp, Barrett Business Services, and Matthews International Corp. Information technology made up 10.3%, with investments in Assure Software, Information Services Group, Powerfleet, and Vera Mobility Corp. Consumer discretionary was 9.1%, featuring Lakeland Industries, Motorcar Parts of America, and Target Hospitality Corp. Energy was a smaller part at 3.9%, mainly Secure Waste Infrastructure Corp. And finally, real estate at 2.4%, with International Workplace Group plc. In addition to stocks, the fund held 10.3% in a money market fund, the Dreyfus Treasury Securities Cash Management Institutional Shares. This likely represents cash and short-term investments used for liquidity or waiting for investment opportunities. The total cost of all these investments was about $43.3 million. while their market value was higher at $68.4 million, meaning they had a good unrealized gain on paper at that time. Looking at the statement of assets and liabilities as of the 30th of April 2026, the fund's investments were valued at over $68.4 million. It lists various liabilities like payables for investment advisory fees, audit fees, and administration costs, totaling around $125,926. This leads to the net assets of $68,344,489. In the statement of operations, we see how the fund made or lost money during the year. Total investment income, mostly dividends, was about $751,707. However, expenses were higher, totaling nearly $831,000 after some waivers and reimbursements. This resulted in a net investment loss of about $79,115 for the year. But the fund managed to make a significant net realized and unrealized gain from its investments, totaling over $8.8 million. This boosted the net increase in net assets from operations to a positive $8.7 million. The statements of changes in net assets show a clearer picture of the year's activity. For the year ended the 30th of April 2026, the fund had a net increase in net assets from operations of over $8.7 million. They paid out dividends and distributions totaling about $1.5 million. Shareholder capital transactions, meaning money coming in from new investments and going out from redemptions, resulted in a net decrease of about $4 million. Overall, the net assets of the fund increased by about $3.3 million during the year, bringing the total to $68.3 million. The financial highlights provide a per-share breakdown. For Class I shares, the net asset value per S-share at the beginning of the year was $17.06, and it ended the year at $19.08. This represents a total investment return of 14.26% for the year, confirming what we saw earlier. The expense ratio remained stable at 1.20%. The notes to financial statements provide crucial context. This fund is an open-end management investment company, which means it can issue an unlimited number of shares. They use standard accounting practices for valuing their investments, often relying on market prices, but also using fair valuation for securities where market quotes aren't readily available. An important detail here is the relationship with the investment advisor, Private Capital Management LLC. They are paid a fee based on a percentage of the fund's assets, but they've also agreed to cap total operating expenses at 1.20% of average daily net assets for the year ended the 30th of April 2026. The advisor earned advisory fees of about $623,000, but also waived or reimbursed over $108,000 to keep expenses within that cap. This shows the advisor's commitment to managing costs for shareholders. They are also entitled to recoup these waived fees for up to 3 years, if the fund's expenses allow. The report details that as of the 30th of April 2026, there is about $382,000 in potential recovery for waived fees over the next 3 years. As we wrap up, the key takeaway is the fund's divergence between short-term and long-term performance. While it lagged its benchmarks this past year, the managers are focused on long-term value, investing in companies they believe will outperform over several years. This approach, focusing on fewer high-conviction picks, is often seen in active management. The decision of whether this strategy is right for you depends on your investment horizon and tolerance for year-to-year performance variations. The risk I am watching is this fund's ability to consistently deliver on its long-term outperformance promise, especially when market conditions favor broad index gains. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more. Join our Discord community, link in the description.